The endowment effect is another model that we can talk about that is particularly relevant to investing and has close ties to the concept of loss aversion. This theory comes straight out of psychology textbooks and behavioural economics, and it can be simply described in the following sentence. People ascribe more value to things merely because they own them. This concept has been illustrated in a number of social experiments where it's been shown that people, when given a good, are reluctant to trade that good for another good of similar value. In one example, participants first given a Swiss chocolate bar were generally unwilling to trade it for a coffee mug, whereas participants first given the coffee mug were generally unwilling to trade it for the chocolate bar. In another study by Kahneman, Knetsch and Thaler, it was found that participants typically require compensation of twice the value of the thing they own before they will consider swapping it. According to Kahneman and his colleagues, this endowment effect occurs, at least in part because once a person owns an item, foregoing it feels like a loss and humans are averse to losses. That is, they would rather not lose something than gain something of equivalent value. There are clear examples of the endowment effect taking place in the stock market. For example, it's very common to become emotionally tied to a stock that you own, perhaps owning it longer than you should. This is especially true if you've held the stock for a very long time, or if it's been a winner for you in the past. The solution to this, as so often, is to take a more business-like approach to your investing. Ask yourself if you really want to hang on to this investment, or would your capital be better deployed somewhere else? Can you calculate a more accurate value of your investment and rid yourself of the endowment bias?